According to the latest statistics from the ABS, our economy is roaring along. The most recent data, which unfortunately is very backward-looking to the June quarter, showed that Aussies were released from their lockdowns earlier in the year, and we spent on ourselves, and that helped our economy grow. But since then, the Reserve Bank has raised interest rates, and it's going to continue to do so. So is this going to kill our booming economy, and what will it do to our property markets? That's what I discuss in today's podcast with Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing economist. So welcome to today's podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
If you're a regular listener to this podcast, you'd know that each week I also have a Property Insiders chat with Dr. Andrew Wilson on our YouTube channel. And today I want to play the audio of one of our recent chats. But before I do, I want to give you some context. Of course, the media is still full of talk about rising inflation, higher interest rates, and what that's going to do to our economy and our housing markets. Now, while there are many factors affecting our housing markets, interest rates are only one of them. But I still believe the extent to which the Reserve Bank is going to hike rates to cool inflation will be a key determinant of the condition of our property markets for the balance of this year. But a large part of what's happening has really got to do with consumer confidence, which in reality is, in my mind, the biggest driver of our housing markets. If you think about it, consumer confidence is a self-fulfilling prophecy. If people feel positive about their financial future, their wealth, the economy, they're going to spend more on all sorts of things, including housing, and that drives up property values. On the other hand, if consumer confidence is negative and people are worried about the rising cost of living or higher mortgages, they're going to sit back and wait for a while. They're going to wait to see when the picture's clearer, and therefore our housing markets will languish. So, will inflation continue to run hot, and will this force the Reserve Bank to raise interest rates higher? Or are there already signs that some of the contributors to higher inflation may be easing, allowing the accelerator to take a foot off the brake? Well, that's what you're going to hear in my discussion with Andrew in just a moment. But first, let's look at what some of the data shows. As I said, you'll hear in a moment in my chat with Dr. Andrew Wilson that Australia's economy continues to track better than almost anyone expected. And the second quarter GDP just showed that our economy is growing at a very robust pace. Now, while the expansion was broad-based across spending, across income, across production, a lot had to do with consumer spending. They were spending their savings. So moving forward, a lot's really going to depend upon the consumers and whether households are going to continue to spend as rate rises absorb parts of their budget. Now, of course, not everyone's feeling the rate rise. Half of those who own a home in Australia, they don't even have a mortgage. And that's because they bought their home many years ago and they've paid off their loans. And others have got fixed rate mortgages, meaning they're not currently feeling the pinch. However, it is going to be a delicate balance moving forward for the Reserve Bank on the one hand to quell inflation, but on the other hand not to dent our economy too much. Now, this month, the Reserve Bank, of course, continued to hike interest rates, lifting the cash rate another 50 basis points at its September meeting. And that was the fourth consecutive double increase. In fact, it was the fifth consecutive hike. And it's taken the cash rate to 2.35. Now, that's the highest it's been since 2015. But in a statement following the September decision, Reserve Bank Governor Philip Lowe said the board remains committed to overcoming the challenge of high inflation and preserving its credibility with respect to that rate it wants to get inflation to the 3% target. The statement also hinted that there's more to come. It noted that the Reserve Bank expects to increase interest rates further over months ahead, but added again that there's no preset path and the board's going to be guided by incoming data. Now, in my chat with Andrew Wilson, you'll hear what his thoughts on that are, how many more rate rises and what's ahead. But what does all this mean for home prices? Well, the fastest rise in cash rates since 1994 has seen home prices weakening across the country, and prices are falling in capital cities and in regional locations. But despite the falls, prices are still significantly above the pre-pandemic levels. The market's doing what it's always doing. It cycles. Now, regional locations are remaining about 50% above their March 22 figures. In other words, when the pandemic started, capital city prices are 26% up over the same period, but regional property values have only recently started falling and are going to continue falling, in my opinion. Of course, as borrowing capacities are constrained and buyers' budgets shrink, the most expensive markets, particularly Sydney and Melbourne, are leading the price declines, just like they led the price booms. But the most recent September's rate hike is going to further increase borrowing costs and reduce maximum borrowing capacities. And it will, to a degree, push property for prices down forward. But let's put it in perspective. As the current rate hikes are passed through mortgage rates, the maximum borrowing capacity for a typical borrower is likely to actually be reduced by up to 20%. In other words, to be able to service their mortgage unless APRA changes its buffers, and I hope they do. Remember, in 2021, APRA increased the buffer so that banks had to make sure that you could service a loan 3% higher than the going rate at that time a year ago. Of course, they did the right thing and interest rates have gone up. But in my mind, now they should be lowering that buffer. And that's what's happened overseas in England. So let's see if that happens here. But I guess the point I'm making is that it's likely that the average typical borrower isn't going to be able to borrow as much. And it could even be about 20% less. But that doesn't mean property values are going to drop 20%. It just means that buyers are going to have to look at a different location, or maybe they're going to have to buy an apartment or a townhouse or a villa unit rather than a house. Think about it. Just because a particular buyer's budget drops from $1 million to $800,000 doesn't mean that a particular vendor who is asking $1 million for his home is going to need to drop his price 20% to suit that particular buyer. Just like this theoretical buyer is going to have to move to an adjoining cheaper suburb, other potential buyers are going to ripple from higher priced adjoining suburbs that they're now priced out of into the budget of $1 million, and property values aren't going to drop as much as some people are suggesting. But in my mind, as I said, it's lower consumer confidence that's holding back buyers and stopping sellers putting their homes on the market. And this is only going to return once it appears that we've got inflation under control and interest rates reach their peak. And this is likely to be later this year, early next year for inflation, and the first quarter or so for the peak of interest rate rises. And when that happens, the pent-up demand will ensure that property markets move forward again. Now, as you'll hear in my chat with Dr. Wilson, the economic data hasn't weakened despite this rapid rise in interest rates. Outside the housing market, the economy's entered this tightening rate rise cycle with quite some strong momentum. And as I said, consumer confidence has fallen, but on the other hand, the labour markets are tight. Anybody who wants a job has a job. The unemployment rate's at a 48-year low. Spending is yet to slow because people are pretty confident about their finances, and business conditions remain strong as well. And what this has meant is the Reserve Bank has allowed the Reserve Bank to continue raising interest rates to what it calls neutral. Now, no one knows exactly what a neutral rate is. We discussed this in previous podcasts, but it's probably somewhere around 2.5% to 3%. That's the level of cash that's neither expansionary or contractionary. So the Reserve Bank's carefully monitoring household spending as interest rates rise. And that's, I guess, a key source of uncertainty, how they're all going to be affected by rising interest rates. But as I explained, the lagged effect of rate rises and the large share of variable rate borrowers who are well ahead on their repayments, and those borrowers on fixed terms yet to expire, means many mortgage holders haven't yet felt or are only beginning to feel the impact of rising rates. Now, according to the Reserve Bank, around 60% of all borrowers currently have variable rates. In other words, 40% of borrowers won't have seen any increase at all in their monthly payments because they've got fixed rates. And a lot of those were fixed when the cash rate was very, very low. They fixed over the last year or two, as did I, and other borrowers have actually kept their repayments at the same levels as they used to be when interest rates declined. So a lot of borrowers are well ahead in their mortgage payments. Another substantial portion of borrowers will so far be insulated from these initial increases because, as I said, they've had fixed rates taken out through the COVID period. So there will still be some lagged effects. There's a lag between interest rate rises and when people start to feel them. So we're going to really have to see how all this plays out moving forward. But as you'll hear in my chat with Andrew, he feels that rate rises won't be as high as some people predicted. And in fact, the money market is suggesting the same. They don't think rates are going to go as high as initially predicted. Now, that was a rather long introduction, so let's get on with my chat with Dr. Andrew Wilson. And as I've mentioned, this is the audio of one of our regular weekly Property Insider discussions. So if you want to keep up to date with what's happening to our property markets, please subscribe to my YouTube channel. Go to YouTube and look for Michael Yardney, or go to www.propertyinsiders.info. I'll leave a link in the show note that'll take you directly to our YouTube channel. Our economy roared, but will inflation and rising rates put an end to that? The most recent data showed that Australia's economy grew by 3.6% in annual terms. As the lockdown shackles loosened, Australians bought more shoes, more clothes, more coffees, and they helped the economy grow by a healthy 0.9% in 3 months to June 30th. Unfortunately, this latest data we've just received is quite old now. It's quite lagging, isn't it? But the Reserve Bank has raised cash rates 1.5 percentage points since then. So is the outlook souring with inflation and rising interest rates starting to eat into our household budgets? What does this mean for our economy and our property markets? There's some of the questions I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing market economist. We're also going to talk a bit about the outlook for interest rates, the latest rental data from Dr. Wilson's My Housing Market, and also what our auction markets are telling us. And it's not what some of those property pessimists were predicting. Hi, Andrew.
Good morning, Michael. Good to be here again, and some more interesting data this week, of course. And we are now well and truly into spring. Happy spring to everybody.
Well, the spring property market's doing well, and we'll get onto that. But let's just talk about the economic data first, because the latest ABS data published last week revealed Australia's economy grew 3.6%, but that was to the 3 months ended June 2022. And this was higher than the long-term averages, but it was mainly driven, Andrew, as I read it, by higher household consumption and stronger exports. The massive number of Australians spent their lockdown savings. They went on holidays, they ate out. I know I did the same, and that drove our economy. But how long can this go on for? We can't keep spending our savings. What's going to happen with interest rates, and how is the rising interest rates going to affect our economy moving forward?
Well, the GDP numbers were a little bit higher than for the March quarter, 0.9% over the quarter, which I think is not too bad. I wouldn't get too excited about it. It's around about the numbers we were having pre-COVID. But of course, there are conditions that are different to pre-COVID conditions that are driving GDP growth at the moment. We had very strong terms of trade. Of course, as you mentioned, spending continued. We're still out there spending. And I think you're right. I think people are taking holidays and continuing to get on with life, I suppose. A little bit of relief after lockdowns are finished, and we're a lot more circumspect in terms of controlling COVID. Just been announced, of course, that you don't have to wear a mask on an aeroplane anymore, which I was coming back from Noosa Heads just the other day, and the first time in a long time I didn't have to wear a mask on the planes. We are normalising, and I guess that reflects itself in still strong consumption in terms of our GDP numbers. And the other factor was quite strong terms of trade. We're doing well as an exporting nation, particularly with our resources and our agricultural exports as well, given the shortage or higher demand and constraints with delivery, etc., that are pushing up prices. So volumes and prices were up for our exports, and that contributed also significantly to GDP. But the bottom line is that I guess our GDP grew where the US GDP fell. So we're doing pretty well. And again, we're doing pretty well all through this inflationary period compared to other similar economies, whether it be in terms of GDP or the actual inflation rate on a comparative basis, or other factors such as wages growth. Another good result for Australia going forward.
Andrew, the Reserve Bank predicted that GDP is going to start slowing now. I mean, that's what it wants, and they're suggesting it's going to slow to 1.8% in annual terms by the June quarter in 2024. That's roughly half of what it is now. But also the Reserve Bank Governor, Philip Lowe, hinted he's ready to take his foot off, well, maybe at least one of the feet on the brake. I think he had both feet on the brake pedal in the last little while. Is he going to wait until it's clearer whether the 5 straight interest rate rises are going to have the desired effect? Because there is a lag on how long it takes to slow the economy and slow our spending.
Yeah, but again, Michael, his problem is that the data is backward looking. You don't want to be saying, oh, well, the inflation has eased, so we can stop raising interest rates. But in the meantime, you've been raising interest rates, which is actually contributing to higher inflation. I think Australia's been well positioned, good policy, good luck, who knows, but certainly in comparison to other similar economies. And I think that we can afford to be just a little bit more optimistic now going forward. And I think that does mean that we can afford to start easing back on those interest rates increases, and maybe the next one could possibly be just back to the 0.25% and wait and see what will happen going forward, because we are moving towards the end of the year, Michael. And of course, really November is the last action day, or the November meeting is the last action day for interest rates, because December really is not much good in terms of its effect, because we're all in holiday mode for a couple of months till the bank meets again next February. But as I say, I think that, signs are certainly improving, Michael. I think we can be more optimistic now, and I've been saying this now for a month or so, that the outlook for inflation and interest rates is that we may peak lower than expected and sooner than expected.
And when that happens and people recognise, hey, this is as bad as it gets, hey, our interest rates, our mortgage rates are not going to get any higher, I can see them getting into the property markets, and the pent-up demand that is now being created is going to ignite our markets. Not to the extent it did a year or two ago after our COVID lockdowns, but life will get back to normal in property.
Yes, that's right, Michael. And those key drivers of inflation, which the Reserve Bank should be focusing on, which are more real-time, certainly reflect that the price of oil has fallen sharply and continues to fall. Of course, that can be a very volatile commodity, oil prices, but certainly the trend is clearly downwards now. And also the My Housing Market Building Cost Index is also falling on a monthly basis now. So house building costs are starting to ease. I mean, it's still high compared to a year ago, but the trend is downwards there. And of course, inflation is all about the growth from period to period, not the level of prices from period to period.
That's a point that I think a lot of people actually forget, that it's the change in growth in that period. Now, one of the factors that we keep an eye on is home lending, because it's a leading indicator. When people get their finance pre-approved, they're clearly looking for property, and home lending fell over the July period.
Well, no surprise, Michael. Home lending again down and down sharply, but the levels are still certainly high compared to the pre-COVID home loan activity. And we've come through a very strong period of growth. A lot of that pent-up demand through COVID has been released. Also, lower interest rates and stimulus packages that activated home buying. And the FOMO, of course, was a significant factor, fear of missing out. So I guess we're getting back to more of a normalised environment for home lending. And when we look at affordability measures in terms of the proportion of the average income that the average loan is taking up, that's rising significantly. So affordability has certainly also pushed buyers out of the market, but this is the nature of the cycle, Michael. Once prices get to a certain level, we can't afford to pay anymore. and a lot of demand is satisfied and buyers are sidelined. So no surprise that home lending levels have fallen, but they're still in real terms quite high compared to the pre-COVID period, Michael.
I know once a month my housing market brings out their rental reports, and over the last little while, houses have had very strong rental growth because vacancy rates have been low, but the apartment market, the unit market's now starting to pick up, Andrew.
Yes, Michael, that's been the trend over recent months, is that we've just seen an easing in house rents, and I think that's all about affordability. House rent increased remarkably over the past year, and it just gets to a point where tenants can't pay any more. And I think what we've seen as an offset to that is higher unit rents. Rents are continuing to rise. And I think perhaps at some level that represents, particularly in Sydney, the shift from houses to units, because houses have become so unaffordable. And there are obviously fewer houses now available for rent. But there's no doubt that unit rents are rising consistently in most capital city markets. So again, it's underscoring that shortage of dwellings that we have, Michael, and the shift for more affordable dwellings, which of course is units versus houses. But still, the unit market has skyrocketed in terms of its rental increases over the last year, as well as houses.
Well, with the housing market, I know that my housing market house rental figures show that the highest vacancy rate around Australia is Melbourne at 1.2%. And I'm saying highest with inverted commas because really that's a very, very low vacancy rate. There just aren't enough houses for rent. But even when you look at the units, Melbourne again had the highest vacancy rate at 2.3%. But when vacancy rates are 0.5 like they are in Adelaide, 0.8 in Perth, 1% in Darwin, there's just not enough houses. You need available houses as people change their lifestyle, move house, have different requirements. There obviously are long queues for vacant properties at the moment. There are stories on social media of people sleeping in cars and tents, which is terrible if that's really true. But I guess it means that rents have only got one way to move, and that's up, Andrew.
Well, that's right. Absolutely. And when we look at the big picture, Michael, on the supply side, the latest building stats were terrible because they showed a significant collapse in unit development. When we look on the demand side, we've still got to get all those migrants back into the country, and they're going to have to find somewhere to live. So again, it's under supply, high levels of migration with borders opening and low levels of new dwellings, so that can only mean higher rents.
Well, let me tell you what the wrong solution would be, and that's to fix rents, to stop rents going up as the Greens came up with. That's not going to help supply. All that's going to do is push investors out of the market. But I see that they've done that in Ireland and they've done that in Scotland.
Yes, again, we've got to look at the local factors to see what the big picture is there. We've had various rent control mechanisms in various constituencies, Michael. New York's a famous one there because they're always short of property in New York. Their rents have gone through the roof. And that's become very problematic for their rent control properties there because landlords are finding it very difficult to make money. And that's the point you made. If landlords, it's a business like any other business, and if you stop the profit margin by reducing your income, it gets to the point where there are other options. So you only create fewer investor properties or investor appetite for property, which means fewer rental properties. People do end up, unfortunately, sleeping in cars and on the streets because if you just don't have the rental properties, it doesn't matter what you're charging. People have got nowhere to live.
Now, I know every Saturday you work hard analysing the auction results around Australia. You're the first one to release detailed reports every Sunday morning, not just on the state auction results, but you break them down by region and you break them down by houses and apartments, which makes more sense than just an overall result. You report them every Sunday on LinkedIn and we do on Property Update. And the auction markets have started spring with some strength, Andrew.
Yeah, inarguably, Michael, the trend is clearly upwards, particularly in Melbourne and Sydney. And of course, Melbourne and Sydney have led the charge downwards in this correction environment over the last couple of months since interest rates have been rising. But certainly there's a much more positive feel about both the Melbourne and Sydney auction markets. And of course, we know those auction markets are very good forward indicators of what's happening on the ground because they happen from weekend to weekend, whereas the price data and other models of housing market activity lag because you have to take them over a longer period of time, a month or a quarter. So the auction markets certainly in Melbourne and Sydney have picked up recently. We saw quite a 2 weeks in a row with the Sydney market picking up now with a clearance rate over 65%. I think it's important, not just the actual number, but to look at the trend. And the Sydney market has certainly been trending upwards over the last 3 or 4 weekends and is now firmly in that low to middle 60% range. I think just as a rule of thumb, Michael, it's interesting to comment that when we start getting clearance rates around 65%, it's probably the neutral point for prices growth. So I guess the balanced market is, we could say, at around about 65% clearance rates. And once we start moving above there, we start having demand ahead of supply. And I think that's the question: will we start to see auction clearance rates moving towards 70% through spring, which would be the point where we could start to say that the market is recovering in terms of prices growth? But no doubt the trend is upward in Melbourne and Sydney. Melbourne has actually been quite a resilient performer over the last month or more. It's really been firmly in that low to middle 60% range over the past month. And what we're seeing in Melbourne now is, as we would expect, a big rise in listings. There was a big jump in listings, auction listings on the weekend in Melbourne. So these are tests for the market, whether they can absorb the surge in listings at the same rate as they have been over the past couple of weekends, at least in Melbourne and Sydney. Going forward, we can certainly say that the spring selling season has started as it usually does, Michael, with more buyers and sellers in the market. The smaller markets, we're still seeing Brisbane certainly flatter than where it was, but the surge in migration is certainly ended in Brisbane that created that remarkable drive into the market last year. Adelaide's remained quite stable, certainly still the top performer. And again, the Canberra market not really showing any signs of revival, but it too is in recovery mode, or looking towards recovering from what was a very strong period. But more listings to come through shortly, Michael, which will certainly test those early spring markets.
Well, we're into the last quarter of the year. I don't think the dire predictions of substantial drops are going to happen. The market hasn't found a bottom yet, but it's looking for a bottom, isn't it?
Yeah, absolutely, Michael. It's just feeling its way in the bottom, particularly Sydney and Melbourne, which were, of course, the leaders in terms of price declines, which we shouldn't be surprised at, because they were the clear leaders in terms of price increases last year. So it's all not working at the same level. But as I said, I think clearly the auction markets are telling us that the market is improving. There's no doubt about that. And it's just a question of whether prices will follow going forward, and whether the big picture is whether higher volumes of stock for sale will find higher levels of buyers. And so interesting times ahead. But certainly I think the doomsayers will be just perhaps starting to revisit some of their predictions of recent months, Michael.
Well, those predictions of taking a weekly or a monthly figure and multiplying it by 52 or by 12 doesn't really make sense, as we're finding that the slowing down of our markets, which are a real thing and happen every cycle, the slowdown is starting to slow down.
That's right, Michael. And this could be, and I think we've discussed this could be quite a shallow correction phase. And we are desperately short of housing in this country. And that's the bottom line for any economic conundrum, is the nature of supply and demand. And there's no doubt that we just don't have enough houses.
Well, I look forward to catching up with you again next week and looking at all the housing market data. Thanks, Andrew.
Thank you, Michael.
In a moment, I'm going to share my mindset message with you. But if you're like many investors or potential home buyers, you're probably wondering, what's going on? Is it too early to get into the property cycle? Is it too late? Should you buy? Should you hold? Should you even consider selling your property? Like it or not, as Andrew and I explained, we've moved into a flatter period of the property cycle. Sure, we had a few amazing years from a property investment standpoint, but that doesn't mean it's the right thing to do to sit on the sidelines. Yes, we're experiencing high inflation, rising rates, more economic uncertainty, and yes, the media is remaining to be full of mixed messages. But on the other hand, admit roll, some of our more experienced long-term thinking strategic investors are seeing this as a great opportunity to get set in the property market at a time when there's less competition. Now, I don't know your situation, but I do know that it's a window of opportunity for those with a long-term focus, because as I explained, in due course, interest rate rises will reach their peak and inflation will come under control. And at that time, greed will overtake fear and buyers will be back into the markets. So why not go to metropole.com and have a chat with our property strategists and allow us to put a strategic plan in place for you, because property investment is a process. It's not an event, and you've got to do things in the right order, because the property you eventually buy will be the physical manifestation of a whole lot of decisions you have to make. metropole.com.au and find out about our time-tested frameworks that I've fine-tuned over 5 decades and our proven track record. We've had close to $5 billion worth of property transactions. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you, would you like to work 2 or 3 days a week? What would you do with your time if you only had to work 2 or 3 days a week? Now, I'm old enough to remember days when experts predicted that we'd only be working 14 to 15 hours a week by now, and we'd have so much leisure time we wouldn't know what to do with ourselves. Instead, while the official work week is still 38 hours, many Australians work considerably longer than that in order to finance their increasingly expensive lifestyle. Now, according to CNN Money, way back in 1930, renowned economist John Maynard Keynes predicted that technological advances would mean we'd all eventually only be working 15 hours a week. That same year, evolutionary biologist Julian Huxley predicted the 2-day work week. Both men warned that someday we'd have so much leisure time we'd be bored out of our brains. In 1930, Huxley said the human being can consume so much and no more. When we reach the point that the world produces all the goods that it needs in 2 days, as it inevitably will, we must curtail our production of goods and turn our attention to that great problem of what to do with our new leisure. So way back then they predicted we'd be able to work so much more efficiently that we'd have a shorter work week and longer vacations. Now, more recently, I remember experts predicting that the advent of computers and then the internet and then the fast-paced growth of technology would mean we'd be able to telecommute and work from home. Well, interestingly, that's happened with COVID, hasn't it? And there's no doubt that the technological progress has made us much more productive than ever before. But rather than shortening our work hours, instant messaging, emails, and our smartphones and the 24/7 news cycle just seem to have made life more frantic. Then there's the fact that our more expensive lifestyle, coupled with inflation and taxes, means that living how we choose to live is costing us more. And many average Australians, well, they're just even struggling to make financial ends meet. So here's the lesson. You'll never get rich by working longer hours. Earning, saving and investing are really the only 3 levers you have available to control your finances. And for most people, working longer and earning more is the only way they know how to get rich. However, you'll never become wealthy working longer hours, as I said, or shorter hours as was predicted. Sure, you'll earn higher wages, but you're going to be taxed more, inflation will erode some of it, and you're more likely to spend more. And of course, you can't save your way to wealth. It's just too hard. On the other hand, a group of Australians, strategic investors, have built themselves a substantial asset base of investment properties that then act as a cash machine. First step is building your assets and then moving to cash flow. And this can replace their personal exertion income and fund the lifestyles allowing them to eventually work 2 or 3 days a week if they choose. So how do they do this? Well, as I said, initially they worked hard, they spent less than they earned, they invested the balance and kept reinvesting their funds following a proven investment strategy. Hey, there were no shortcuts. It took time, often 10 but much more likely 20 and sometimes 30 years to allow the magic of leverage, capital growth and compounding to grow their asset base. But now they've got choices in life. Now they can choose to work 2 or 3 days a week or not. As Warren Buffett wisely said, wealth is the transfer of money from the impatient to the patient. We're living in interesting times, aren't we? But twice a week I'll be back with the Michael Yardney podcast to help give you some clarity and direction. But if you've got some benefit from this, please help somebody else understand what's ahead. On every podcast app where you're listening to this, there's a share button. On iTunes, there's a couple of buttons down the bottom if you just press it and share it with somebody, or just tell somebody about the Michael Yardney podcast, or why not tell the world by leaving a review? I'd really, really appreciate that. Now, I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney. And why not subscribe to my YouTube channel so you can get the regular weekly Property Insider chats with Andrew Wilson? Just look for Michael Yardney on YouTube or propertyinsiders.info. You can also join my private Facebook group. There's lots of places to find me. The Facebook group is Property Update Private Facebook Group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?